But meantime, we want to bring you a very special guest, an important conversation. Neel Kashkari was the government's first $700 billion man. He headed up TARP when the program began. Now he says that the country still faces serious economic and financial problems due to entitlement payments, and attitudes need to change. He joins us now from California, where he's currently the head of investment initiatives at Pimco. Good morning to you, Neel. It's great having you on the show.
Good morning. Thanks for having me.
Now, entitlement programs, the term sounds antiseptic, so let's call them what they are. We're talking about veterans payments, jobless benefits, Social Security, Medicare, Medicaid. You think right now that basically keeping all of those programs functioning without cuts is causing this country to head towards fiscal disaster?
Well, over the past few decades, we've made commitments that are currently written in law, and that if the law is not changed, those programs will grow to unsustainable levels, and that means we'll have a lot less money to spend on other priorities such as defense or national security, education, basic research. Just a few days ago, the Congressional Budget Office came out with a new report looking at our deficit situation, and if the U.S. Treasury market comes under a lot of pressure and Treasury rates go back up to where they have been historically, it'll mean that we're spending a lot more money every year on just servicing our debt. They estimate it could be another $500 billion a year just to service our debt, and that's 10 times what we spend on Homeland Security. It's 5 times what we spend on education. So the entitlement programs are very important. They provide real services that Americans rely on, but we have to be cognizant that we cannot let them grow out of control.
In a recent editorial, you posed a question, will a bond market provide our country time to heal economically and emotionally in order to tackle entitlements? Answer your own question here, because when I take a look at the bond markets, I hear what you're saying, but we're still seeing the U.S. Treasury is acting as a flight to safety asset class.
No, you're right, but we shouldn't be fooled by that. The absolute size of our deficits matter, and our relative position matters. Today, we're the strongest weakling, and so Europe is weaker than the U.S., so the U.S. looks relatively better. But to the extent that Europe or other countries get their own acts together, our relative position could change very, very quickly. We always ask, why didn't regulators or policymakers see the housing bubble coming? Why couldn't we take preventative action then? Wouldn't it have been better for our country? And the answer is it would have been much better. The good news is we see this fiscal crisis coming. The policy options to control our deficits are easy to list. This is not an economic challenge. This is a political and cultural challenge to rally ourselves in a bipartisan manner to make the hard choices we know we need to make.
We saw how hard that was to sell in Europe, right, with all the austerity programs that were enacted in Greece and Ireland, et cetera. Do you think that we're beyond crisis in Europe right now?
Well, they're in the middle of it, and the people in Europe and in Greece are suffering because of that. If we can rally together as a nation, it'll be much less costly for us to deal with these challenges today. If we wait until we have an acute fiscal crisis in our country, not only will we have much less money to spend on other priorities, but confidence in the U.S. economy could suffer. And so the cost to the American family will be much higher if we wait than if we deal with it today.